All right, welcome to this explainer. Today, we're putting on our investment analyst hats and diving right under the hood of Goodyear tire and rubber to make sense of some absolutely extreme financial whiplash. We're looking at a classic American industrial giant that just posted a quarter so triumphant it had analysts cheering, only to follow it up with a quarter so bruising it left Wall Street completely divided. Let's unpack exactly what happened and figure out why this company is currently one of the most fascinating debates in the market today.
Okay, let's just get right to it and look at this number. $5.96. That's Goodyear's recent share price. To put that into perspective, this stock has been pushed deep, and I mean deep, into beaten down territory. It dropped roughly 32% year to date and nearly 48% over the past year. Now, for any retail investor looking at a legacy brand with a share price this low, it immediately begs the ultimate valuation question. Is it cheap for a reason, or is the market missing a massive opportunity here?
And here is where the context gets incredibly interesting, especially if you're a fan of Benjamin Graham's deep value philosophy. The stock is trading at $5.96, but the actual book value per share, literally the net asset value of the company on paper, is $10.45. It's trading at just over half of its actual intrinsic book value. In the financial world, that massive discount is a classic margin of safety setup, making Goodyear an instant magnet for value investors who love buying assets for pennies on the dollar. But despite having these premium, widely recognized physical products out on the road, Wall Street is still deeply divided. Is this iconic $1.75 billion company a Peter Lynch-style turnaround just waiting to happen? Or is it a sinking ship? You've got some analysts slapping strong buy ratings on it, while others are frantically hitting the sell button. To understand this crazy tug of war, we really have to look at the tale of two completely different quarters. Part 1. The bull case. A structural margin reset. So if you only looked at the end of last year, you'd think Goodyear was teaching a masterclass in corporate efficiency. Just look at these Q4 2025 numbers. Segment operating income hit $416 million. Their operating margin jumped to 8.5%, which was the highest level in more than 7 years. But the real showstopper? Goodyear generated over $1.3 billion in free cash flow in just 3 months. That is one of the strongest quarters for cash generation on their record. And this wasn't just some happy accident. It was the direct results of their Goodyear Forward transformation plan. Management aggressively targeted cost savings across their entire footprint. We're talking plant optimization, purchasing, the whole supply chain. They initially aimed for $1.3 billion in run rate savings, but they actually bumped that target up to over $1.5 billion. They executed exceptionally well, and that efficiency flowed right down to the bottom line. On top of that operational efficiency, they completely optimized their portfolio. They made the tough but necessary choices to sell off non-core assets. They successfully divested their off-the-road equipment business, the Dunlop brand, and their chemical business. By October 2025, these strategic sales generated roughly $2.3 billion in total proceeds. But the absolutely crucial point is what they actually did with that money. They took those divestiture proceeds and aggressively attacked their balance sheet. This is exactly what Warren Buffett looks for: manageable debt levels. Total net debt dropped by over $1.5 billion year over year, bringing it down to $5.39 billion. They were structurally resetting their margins, cutting costs, and deleveraging. Honestly, textbook execution. Part 2. The bare reality. Cyclical whiplash in Q1 2026. But just as the engine was really gaining traction, they hit a massive macroeconomic speed bump. In Q1 2026, the entire narrative flipped. Global tire unit volumes suddenly plummeted by 11.6% year over year. That is a massive volume drop for a heavy manufacturing company. They went from 38.5 million units down to 34 million. The culprits here: high channel inventories that led to massive destocking, extreme weather in the US, and a commercial truck industry that was basically sitting at recessionary levels. And when volume drops that sharply, it just wreaks havoc on a manufacturer's profits. Notice the stark contrast right here. Segment operating income went from that triumphant $416 million in Q4 straight down to a meager $95 million in Q1. The margin collapsed from 8.5% down to just 2.4%. It is the literal definition of cyclical whiplash. To really understand the underlying damage, we have to look at the bridge from 2025 to 2026. While that Goodyear Forward plan still delivered a positive $107 million benefit, It was just completely overwhelmed by external headwinds. They took a massive $159 million negative hit from volume impacts, and that included $72 million just from unabsorbed fixed costs. Simply put, when your massive plants aren't running at full capacity to make tires, your fixed costs will eat you alive. Add in inflation and another $67 million hit from tariffs, yeah, their internal improvements were totally wiped out. And the ultimate result of all that? A staggering $249 million net loss for the quarter. Even on an adjusted basis, if we're looking purely at the core business, they still lost $112 million. For an investor, going from celebrating $1.3 billion in free cash flow to staring down a $249 million loss in a matter of months, well, it's a brutal reality check. Part 3. The Contrarian's Dilemma. So this brings us to the core mystery of our analysis. How should we interpret these radically different quarters? The internal mechanics are vastly improved, but the external environment is just punishing them right now. One Wall Street analyst framed Goodyear as a classic cyclical contrarian candidate, saying weak near-term demand and commodity headwinds are obscuring a structural margin reset and aggressive deleveraging. The argument here is straightforward. If you buy when the macro environment looks its absolute worst, that's exactly how you win as a contrarian. When we place the facts side by side on the scale, it's a true balancing act for anyone trying to build a valuation model. On the bull's side, you have the aggressive debt reduction, the $1.5 billion cost program, and the proven ability to hit an 8.5% margin when the conditions are actually right. But over on the bear's side, you absolutely cannot ignore a $300 million annualized tariff exposure, rising import competition, and the harsh reality that raw material costs and freight demand swing wildly. Ultimately, though, it is always worth remembering the underlying product and the economic moat it provides. Tires will always be a non-discretionary replacement purchase. You can delay buying a brand new car, sure, but when your treads are completely bald, you have to buy tires. That means the business model has a permanent floor of demand, provided that management can actually navigate these intense short-term cyclical curves. So, looking at that dramatic plunge from Q4 to Q1, we are left with the ultimate investor's dilemma. Is Goodyear a classic contrarian buy? A temporarily battered titan trading at half its book value ready to soar when the macro environment finally recovers? Or is it a cyclical value trap, just an illusion of cheapness in a company destined to struggle against global forces totally outside of its control? The rubber has to meet the road eventually, guys. Which side of the trade are you on?